हेलो दोस्तों, आप सभी का फिर से एक बार स्वागत है मेरे यूट्यूब चैनल में जिसका नाम है कॉमर्स ट्रेजर। सो फ्रेंड्स, टुडे वी आर गोइंग टू डिस्कस अबाउट सम इम्पॉर्टेंट MCQ related questions on financial management, which is now called as business finance as per the new syllabus. So without wasting much time, let's go and start the discussion. The first question is, the main objective of an enterprise is. So they have given you different objectives. You have to find out which is the main objective of an organization or an enterprise. Now maximization of sales cannot be the main objective. Maximization of profit also cannot be the main objective. So which is the main objective? Maximization of owner's wealth, or wealth maximization is now a main objective of every enterprise. The second question is, which of the following is not an important objective of financial management? So profit maximization is an objective which is important. Wealth maximization is the most important objective. Value maximization is also important. Maximization of social benefits, we do not aim at this in financial management. So the right answer is all the first three, and the wrong answer, that is which is not important, is maximization of social benefits. The next question is, which one refers to cash inflow under payback period method? So in payback period method, which we use for capital budgeting, which of the following cash flows do you take? That is, which is the cash inflow? Cash inflow before depreciation and taxes, cash flow after depreciation and taxes, cash flow after depreciation but before taxes, cash flow before depreciation and after taxes. So we use CF80. So what does CF80 means? CF80 means cash flow after depreciation and taxes, right? So B option is going to be the right option, right? The B option is going to be the right option. The next question is, the concept of present value is based on. So usually there are two concepts. One is principle of compounding and another one is principle of discounting. So in present value, what we do? We discount the value. So the right answer is going to be present value is based on principle of discounting. That is, value goes on decreasing. We use time value of money. Compounding is nothing but value goes on increasing. 10 rupees becomes 11, 12, 13 as the value goes on increasing. Discounting means 10 rupees today is going to be 9 tomorrow. Day after tomorrow it is going to be again lesser, which is called as principle of discounting. The next question is, the cost of capital from all sources of fund is called as. Now what is specific? Specific is nothing but individual source, that is either KE or KD or KP or KR. When it is taken from individual source, it is called as specific. When it is taken from all the sources, it is called as composite. Composite we also call it as overall cost of capital, correct? We make use of term called as KO. Now what is this KO? KO is nothing but KO stands for overall cost of capital or composite cost of capital. Implicit cost is nothing but it is opportunity cost, and simple average cost is nothing but average of all the costs. So now when I say cost of capital from all sources, you have to remember that composite cost is a right answer. The next question is very important and it is asked many times. The overall capitalization rate and the cost of debt remains constant for all degrees of financial leverage is advocated by. So you have four options: traditional approach, net income approach, net operating income approach and approach. Now traditional approach says that up to a certain level, if you use debt, then your value is going to be maximum for your firm and then it is going to decline, right? So it aims at optimum capital structure. Net income approach says that value of the firm is relevant to the capital structure, that is more the debt you use, lesser is going to be the overall cost of capital and more is going to be the value of the firm. What does net operating income approach says that? Net operating income approach says that value of the firm is irrelevant to overall capital structure, that is it assumes that KO as well as your KD are constant, but KE goes on increasing as you go on investing more debt or more in debt. And approach says that you can make use of arbitrage process or homemade leverage, thereby you can change the value of the firm if you are using tax, or else the value of the firm remains irrelevant to the capital structure. So C and D both are irrelevant, but they are asking you in which particular approach overall capitalization rate, correct, that is KO, and KD, correct, that is cost of debt, remains constant. So right answer is going to be C. Answer number C you have to remember. The next question is match the following question. You have been given 8 different terms and you have to match the 4 terms or 4 pairs. Now first one is Modi-Gilani-Miller approach, second one is net operating income approach, third one is short-term money market instrument, and fourth one is factoring. And 4 options have been given. So you have to see now approach as well as net operating income approach, both are capital based on capital structure, but when you see correctly, approach is mostly based on arbitrage process, net income approach is based on capital structure theory. A and B both are capital structure theory, but arbitrage goes with approach. Short term money market instrument is commercial papers. Now what are these commercial papers? Whenever a company, that is cash poor company, wants to raise additional funds, they go for commercial papers. And last one is factoring. Factoring is nothing but it is a working capital management technique which company uses. If the company has to receive from someone, they can give this work to a factor who collects it on their behalf, and the company has to give him certain factor commission. So the right option is going to be A is fourth one. So A fourth, you have only one option. So without saying other options also, you can just put answer as A. So A fourth, we'll check it once again. B is 3, C is 1, and D is 2. The next question is again an important question which is asked many times. The conflicts in project ranking in capital budgeting as per NPV and IRR may arise because of. Now what happens is, many times as per NPV you get a result of accepting a project, and as per IR you get a result of rejecting a project. Now in this case it becomes very difficult to either accept the project or to reject the project. So why this thing happens? It happens because of 3 main reasons. What are those reasons? One is size disparity, second is time disparity, and third is life disparity. Now what is size disparity? Size disparity is nothing but initial investment may be different for both the projects. One may be 10,000, one may be 1 lakh. So it becomes difficult to judge. Second is time disparity. Time disparity is nothing but the flows, that is cash inflows you get. In one project you may get initial more cash inflows, and in another project you may get cash inflows more at the end of the project. Life disparity is nothing but one project may be of 5 years, another project may be of 10 years. At that time it becomes very difficult and it gives conflicting results. So hope you are understanding all the 3 disparities, which is very important. Next question is the degree of financial leverage reflects. Now what does financial leverage reflects? You have to understand financial leverage always reflects the changes between EPS and EBIT, right? It shows the relationship between EPS and EBIT. What does operating leverage shows? Operating leverage shows the relationship between EBIT and sales, right? And combined leverage shows a relationship between sales and EPS. So there are 3 types of leverage: operating leverage, financial leverage, and combined leverage. Financial leverage, it is nothing but relationship between EPS and EBIT. So the last question which we are going to discuss today is, which of the following is not included in the assumption of Myron-Gordon model of stock valuation? So Myron-Gordon has given a model of dividend, right? So he says that dividend decisions are relevant to value of the firms. Means as you go on paying more or less dividend, value of the firms also goes on changing. There are mainly 3 models which you have to remember. One is Gordon's model, one is Walter model, which both says that value of the firm is relevant, and third one is model, which says that value of the firm is irrelevant to the dividend decisions. So what are the main assumptions? Retained earnings is the only source of financing, definitely is a right assumption. Then taxes do not exist, definitely it is a right assumption. Constant rate of firm's investment, definitely is the right assumption. Apart from this, we have 2 more assumptions, that is R and KE, that is your rate of return and KE, expected rate of return, are always constant. And not only that, the retention ratio is once decided is always constant. So finite life of the firm is not right, correct? So what should be the right answer? The right answer should be infinite, right? We assume that the life of the firm is perpetual or it is infinite, correct? It does not closes in a short period of time. We assume that it is going to remain for a long period of time. So it should be infinite instead of finite. So this was all about today's video. I have made one more video on MCQs on income tax. I am giving you the link in the I button as well as in the description. If you have not seen that, please you can also see that particular video. You can also suggest me in the comment on any specific topic on which you want me to make MCQs. If the video was good, please like the video and please subscribe my channel and also press the bell icon so that you can get the notification whenever I come with the next video. So friends, meet you again in the next video with few more important topics.